Okay, we're going to pick up from almost where we left off in class yesterday with Chapter 18 PowerPoint. We'll go through, highlight a few things that I think are of importance, and skip through items which may not be relative to a course of this nature, Intermediate 1. One thing I do want to point out is that this slide was important to recognize that in the principal-agent relationship, the agent is merely selling for a commission. So they don't recognize the full sale, they just recognize their commission. True, they may be the person who bills the full sale and then passes that along seamlessly to the principal that they're an agent for, but the sale should be recorded by the principal and not the agent. Typical would be, let's see, an example of that would be, okay, well, I don't know if it always works this way, and doesn't probably, but let's say we have Avon salesperson selling Avon products. The relationship may be as an agent, which means they don't have inventory, they just sell the inventory of Avon, but from a pragmatic standpoint of business, the customer comes along, orders from the agent bills, and from the standpoint of the customer, it looks like the agent also delivers the product. The agent's really working for the principal back here. The sale belongs to the principal, notwithstanding what the invoice might say, and the agent only should record their net commission. Okay. We talked about consignments and the fact that they're also just making a commission on the sale. We talked about trade loading and channel surfing. Multiple delivery arrangements, similar to multiple delivery purchases of assets. Here, this is on the sale side, what we do if we have a difficult time identifying specific products and services as to their amount of revenue when they're lumped together as a package. How do you allocate that? Do you need to allocate it? So it turns out that this chart turns out that if each item has a value to the customer on what they call a standalone basis, so you go here on the chart, and if all this is falling into place, meaning you have a right of return of specific items and delivery of undelivered items is probable and substantially controlled by the seller. Go back here. Delivery of the undelivered item is considered probable and substantial in the control of the seller. If you meet these tests, then you go next, and you will count for this as a separate unit. And at that point, you do like you did with multiple asset purchases, you allocate based on relative fair values. Otherwise, if you don't meet these tests here, you can wind up just lumping the whole group of assets and or services together as one sale item, not having to account separately for each unit. Okay, that brings us to our long-term contracts. Two methods: percentage of completion, complete a contract. By now you're familiar with at least the names. We spoke about this briefly. Let's just review. Must use percentage of completion method when estimates of progress towards completion, revenues, and costs are reasonably dependable. And then you have to have these conditions, so it's even more. The contract has to specify the enforceable rights. The buyer can be expected to satisfy. Contractor can be expected to perform. And if you look at this slide and try to decipher what the heck is its philosophy, what is it all about, it's, as I said in class, is that under all the conditions of what this long-term contract looks like, it looks like it has every possibility that it will be done. And we don't have reason to think that it's not going to be a going concern concept with the business and getting this contract done. Sure, things will go wrong in the world, and they often do. But in the meantime, we're going to utilize percentage of completion if everything looks like it should be a profit. It should be a contract that gets done. And those are all the should-bes, which would go into the basics of what this is all about, what it says here, about when you must use percentage of completion. The bottom line is that you're going to need to use it more often than not. Complete a contract, the short term. I use the short term of 2 years or less when discussing this in class. That's for sure the tax rule. I don't know whether the tax authorities borrowed it from GAAP accounting or not. They may have. See if the text. You should all check the textbook to see if it further defines what it means short term. Here's another reason why you would use the completed contract. You don't meet the definitions to do the percentage of completion, so you have to do the completed contract. There's no other way. And there's risks of the contract beyond the normal. Again, it goes back to the theory we had when we spoke last time about using percentage of completion. We believe that the entity's going concern, and so is these people they're selling to or buying from. And we believe that here it's the same idea. We believe that the contract will fulfill itself without any unusual risks. That's percentage of completion. But when we do have risks, here we have inherent risk beyond the contract of a normal risk of business, then completed contract should be used, because we don't know that for sure that we'll make the profits that completed contracts say we'll make during the years in construction. I'll say that one more time because that's important. The reason why these all go together to say now you need to use completed contract, which will recognize the revenue at the end of the deal, at the end, no earlier recognition, is that under whatever conditions we're dealing with, there's a fairly high chance that the contract either doesn't get completed or it does get completed, but there's a loss on the contract or something else goes wrong. So percentage of completion would then be potentially overstating actual income earned when the job looks bad from the get-go. All right. We went through how to do percentage of completion. What you should do is you'll get some practice problems. You should read about it, see how the textbook approaches it, and see if you can follow what the textbook does versus what I've done in class. Okay, let's see if there's anything else here. And again, you'll go through class and see how they get their numbers compared to you for percentage of completion. Alright, let's see what we got here. Let's get through the rest of percentage of completion, since we've essentially done that. And here's, I'll tell you what, we'll stop here and we'll pick up from item 4 when we begin next time.